Okay, let's dive into this. Welcome back to The Explainer. Today we're putting a magnifying glass on a seriously fascinating piece of corporate history and, frankly, financial engineering. We're talking about ITC Limited. If you appreciate watching a massive legacy business pull off a near-impossible reinvention while maintaining razor-sharp financial discipline, you are in for a treat today. We're going to explore exactly how this absolute titan transformed from a single-product monopoly into a wildly diversified powerhouse, and then we're going to validate that whole journey with the hard metrics.
Here is our roadmap for The Explainer. First, we'll trace a century of evolution to get our historical context. Second, we'll map out the diversification strategy. Third, we're unpacking those key financial ratios. And finally, we'll look at its status as a nifty 50 heavyweight.
So, starting off with Section 1, a century of evolution. Looking all the way back to 1910, the company actually started out as the Imperial Tobacco Company of India. And for practically the entire 20th century, their massive profitability was anchored almost entirely in tobacco products. But, as we all know, relying on a single vertical, that's a huge risk. What sets ITC apart is how they practically weaponize that steady cash flow to fund a massive, long-term metamorphosis. Today, they've successfully transitioned into a major leading player in non-cigarette FMCG segments, and that shift is validated by a very solid 5-year sales growth of 9.62%. Let's move to our second section and see how this builds into what ITC actually looks like today, the diversification strategy. Because ITC is so much more than just a tobacco company now. They've evolved into one of India's most highly diversified conglomerates. They are heavily involved in packaged foods and personal care, lifestyle products. They own a huge portfolio of hotels. They're leaders in paperboards and packaging. They run vast agribusiness operations, and they even have a dedicated information technology arm. The underlying logic here, extreme stability. By maintaining steady revenues across all these incredibly distinct verticals, they essentially insulate themselves from sector-specific shocks. All right, let's transition from the qualitative story into the quantitative reality. Section 3, unpacking key financial ratios. Let's frame things first with return on capital employed, or ROCE. I want to briefly define this so nobody gets left behind. For capital-intensive businesses, ROCE is the ultimate litmus test. It measures profitability and efficiency in capital utilization, showing us exactly how effectively management is deploying its resources to maximize returns. And get a load of this, ITC's ROCE is sitting at a massive 36.79%. That is an industry-leading efficiency ratio. It absolutely signals to the market that management is exceptionally effective at taking resources across all those diverse segments we just covered and turning them into real profit. Pair this capital deployment efficiency with their 5-year profit growth of 9.16%, and you are looking at the true hallmark of an industry leader. Next up, we have return on equity, or ROE. Just to de-jargonize this a bit, this is a ratio indicating how efficiently a company uses shareholder equity to generate profits. Typically, healthy companies consistently clear the 15 to 20% mark, which growth-oriented investors love to see. Now, what's really interesting about this is that ITC consistently delivers an ROE ranging from 27.32% up to over 29.37%. When you pair a near 37% ROCE with a roughly 28 to 29% ROE, the narrative is undeniable. They aren't just padding top-line revenue through their FMCG segments, they are generating highly profitable compounding growth for shareholders. It reflects superior management through and through. But what about the actual cash hitting the investors' accounts? That brings us to dividend yield. This metric shows the annual dividend return relative to the stock price. It's absolutely crucial for income-focused investors looking for steady cash flow to build conservative portfolios. And ITC delivers a really robust dividend yield of 4.68%. This specific number right here is exactly what makes the stock a massive favorite for income seekers. It means on top of any potential capital appreciation, investors are securing a steady cash flow fueled by those legacy cash cow businesses. Which leads us to a fascinating dynamic when you contrast these two investing styles. For growth-oriented investors hunting for high ROE, well, they're satisfied. And for conservative investors prioritizing high dividend yields, steady income, and reasonable valuations, they're equally happy. ITC perfectly balances growth efficiency with conservative income-generating power. It acts as a rare bridge between two completely distinct investing philosophies. So the crucial point is valuation. You're getting all this efficiency and income at a price-to-earnings ratio sitting comfortably around 17x to 18.6x. While highly inflated growth stocks command massive premiums, ITC offers incredible stability at a very reasonable valuation. And that holds true even as its stock price has been quite active, actively navigating a 52-week low around 275 rupees, all the way up to a high of 427 rupees. Let's zoom out to the macroeconomic view for our final section. Section 4. A Nifty 50 Heavyweight.
As you probably know, the Nifty 50 index uses a free float market capitalization method, and while financial giants like HDFC Bank and oil and gas titans like Reliance Industries hold massive shares, ITC consistently commands a spot right there in the top 10 tier. Depending on market fluctuations and semi-annual rebalancing, their current weightage tends to sit comfortably between 2.5% and 2.7%, even though historical bounds have stretched anywhere from 2.54% up to 3.90%.
And this brilliantly illustrates exactly why being a Nifty 50 heavyweight matters so much for ITC's ongoing stability. It boosts overall market visibility and corporate credibility. It ensures a consistent, passive capital inflow from institutional investors and mutual funds. It improves access to global investors via index tracking ETFs. Ultimately, it cements their status as one of India's most influential and stable performers.
We've traced the history, mapped out the diversification, and verified the incredibly efficient financial metrics, which leaves us with one final provocative thought. Does ITC's century-long transformation from a single-product legacy into a diversified, high-yield Nifty 50 heavyweight offer the ultimate blueprint for corporate survival? It is a fascinating question about corporate adaptability to leave you with today. Thank you so much for joining me on this explainer, and keep learning.